Hi guys, welcome back. Today we are going to talk about the certainty equivalent approach in the discounted cash flow technique. We all know the value of an asset. The value of an asset is the present value of the future cash flows it is expected to generate. So if we want to take the value of say a share of stock, we should be able to reliably forecast its future dividends from a year from now until forever and discount back all of those dividend payments to year zero, that is now, using the appropriate discount rate. Now, we know that the presence of risk can decrease the value of an asset. So, how do we account for such risk? We know that bearing higher risk should be compensated with higher returns. Thus, we say the higher the risk, the higher the return it requires. We do so by increasing the required rate of return, which acts as the discount rate for investments with high risk. In other words, we add a risk premium to the risk-free rate. Having this higher discount rate will have the effect of decreasing the value of the asset. Or alternatively, we can account for risk by trimming the cash flows instead of increasing the discount rate. These two will have the effect of decreasing the value of the asset. We call the latter the certainty equivalent approach. How are we going to do this? Let us compare the two approaches. Case 1. Investment is expected to generate 120,000 pesos a year from now. Currently, the risk-free rate is 4%. However, due to the risk inherent in the investment, the owners believe that a premium of 8% is appropriate. How are we going to account for risk? First, we can use what we have done in the previous discussions. Adjust the discount rate. In arriving at the discount rate, we are going to add risk premium to the risk-free rate. For sub I, required rate of return on the investment, we add an 8% risk premium to the 4% risk-free rate. So the required rate of return for this investment is 12%. We use this rate to discount the expected cash flow of 120,000 pesos to its present value. Again, the use of a higher rate compared to the risk-free rate will have the effect of decreasing the value of an asset. Or, what we can do is to use the certainty equivalent approach. Here, we adjust the cash flow rather than the discount rate. We will begin by calculating the certainty equivalent coefficient. This can be arrived at by dividing 1 by 1 plus the risk premium. In this case, it is 1 over 1.08, considering the 8% risk premium. The certainty equivalent coefficient is 0.92592. Next, instead of using the risky cash flow as it is given, 120,000 pesos, we would adjust it to the certainty equivalent cash flow. We can do so by multiplying the risky cash flow by the certainty equivalent coefficient. That's 120,000 times 0.92592. We will arrive at a certainty equivalent cash flow of 111,110 pesos. We call this the certainty equivalent cash flow. Interpretation of the certainty equivalent cash flow. When we will be given the option to earn 120,000 pesos from this investment or receive 111,110 pesos guaranteed, we will be indifferent between the two. There is risk in the former and none in the latter. We would treat them as equivalents. Again, this trimmed down cash flow, this is trimmed down from 120,000 pesos, would mean that the value will be lower. We use the risk-free rate of 4% as the discount rate to arrive at the present value if we are to discount the certainty equivalent. The key here is to compare apples to apples. If we are using risky cash flows, we would discount it at a rate that incorporates the risk premium. If we are using the certainty equivalent cash flow, where we would consider it to be the risk-free equivalent cash flow, we would use a discount rate that is risk-free. Let us proceed to the next case. This time, we are to calculate the value of the asset. The company expects the following cash flows from a project. Since the project is risky, certainty equivalent coefficients for the cash flows in their respective years are also given. Currently, the risk-free rate of return is 5%. Let us take the value of this investment project. Let us start with the timeline from now until 3 years from now. The first cash flow is expected to be received a year from now, 100,000 pesos. 2 years from now, 160,000 pesos. 3 years from now, 240,000 pesos. Since risk is present in this project, we are going to trim down the cash flow to its certainty equivalent. That is, if we're going to substitute it with cash flows that are guaranteed, we would be willing to receive even a lower amount. The certainty equivalent coefficient for year 1 is 80%, year 2, 70%, and year 3, 50%. Certainty equivalent cash flow for year 1 is 80,000 pesos. Year 2, 112,000 pesos. Year 3, 120,000 pesos. Now that we have the certainty equivalent cash flows, we can bring them back to year 0 using a discount rate that does not incorporate risk anymore, the risk-free rate of return, 5%. Present value factor for 5%, 1 year is 0.95238. This will give us 76,190. For 2 years, it's 0.90703. That would give us 101,587. For 3 years, that would be 0.8684. And that would give us 103,661. Add this up, we have a value of the project, 281,438. That is how you arrive at the value using the certainty equivalent approach. Like, share, and subscribe.